Right, no fluff, no messing about, straight in. Today, we're talking about why your brain is actively trying to make you broke, right? We're diving into behavioral biases in market cycles. Proper CMT level 2 gear, but, for the rest of us.
Yeah.
And I've dragged in the man who's personally been a victim of every single one, Morgan.
Oi, cheeky. Says the one who's telling me about his Dogecoin investment last year. Pot kettle black, mate.
That was a calculated, long-term, strategic gamble. Anyway, let's get into it. You're the one who's actually read the books. Kick us off with the big one, the one that makes people think they can quit their day job after what? 2 winning trades.
It has to be overconfidence bias. This is the absolute classic. You string together a couple of lucky punts, the market's in your favor, and suddenly you think you've cracked the code. You think you're the Wolf at Wall Street, but really, you're the Womble at Wimbledon.
It's so true, though. You start believing your own hype, your portfolio's up 20%, and you start looking at Patek Philippe's online. In reality, a rising tide was just lifting all ships, including your leaky little boat. So how does this actually create a market bubble?
Well, it's rocket fuel for it. A few people get confident, they start borrowing money to trade bigger, they YOLO into riskier assets, then their mates see them making a killing and think, I want a piece of that.
Yeah.
And it creates this positive feedback loop where rising prices create more confidence, which creates even higher prices. Think of the dot-com boom.
Okay.
People were quitting their jobs to day trade internet stocks they knew nothing about purely because they felt invincible.
And we all know how that ended. Tears. Which leads me to my personal favorite, because I see you do this all the time. Confirmation bias. Explain it to the people, Mr. This time it's different.
All right. Guilty as charged. Confirmation bias is just, you make a decision first and find the evidence later.
Okay.
You decide you love a stock, let's say Palantir. You then spend the next 3 hours only on the Palantir subreddit, watching only the bullish YouTube videos, and you high-five every single tweet that says it's going to the moon.
And what if you see a well-researched 50-page report from a hedge fund explaining why it's overvalued?
What do they know? They're probably shorting it, they're dinosaurs. You dismiss it instantly. You're not looking for the truth. You're looking for validation.
Exactly. You're building a little narrative for yourself where you're the hero who spotted the winner early. It's pure ego protection. It's so dangerous because you blind yourself to risk.
Yeah.
You don't see the iceberg because you're too busy polishing the brass on the Titanic.
Yeah.
Right, let's switch to the emotional stuff. The real gut punch biases. Talk to me about herd mentality.
The GME special. GameStop. AMC. This is pure primal FOMO.
Okay.
It's not about logic. It's not about balance sheets.
No.
It's about the fear of being the only one on the platform while the rocket ship leaves.
Wow.
You see a green candle the size of the shard. You see the memes, the rocket emojis, and your caveman brain just screams, get in. Don't get left behind.
It's a survival instinct gone wrong, innit? Like in the old days, if the herd was running, you run with them.
Exactly.
You don't ask if it's a lion or just a bit of wind. In the market, that same instinct gets you to buy at the absolute top. It's like turning up to a party just as the police are shutting it down.
Yeah, perfect analogy. And technical analysts, they see this on the charts.
Yeah.
That massive high volume spike at the peak of a trend, that's the herd going all in right at the point of maximum risk.
Oh, man.
It's the final exhausted gasp of a rally before it kills over.
Painful, but not as painful as the next one. This is the one that really, really messes with your head. Loss aversion.
This is the killer. Studies have shown that the pain of losing 100 quid is twice as intense as the pleasure of gaining 100 quid.
Right.
We are hardwired to hate losing more than we love winning.
Okay.
And it makes us do the stupidest things imaginable.
Give me the classic example.
Okay, so you buy a stock for £10. It drops to 5. A rational trader would reassess. Were my reasons for buying wrong? Has something changed? Should I cut my losses and move on?
Right, the logical thing.
But the loss-averse trader thinks, I can't sell now. I'd be booking a 50% loss. That feels terrible.
Yeah.
I'll just hold on till it gets back to £10, then I'll sell.
The infamous, I just want to get back to break even trade. It's the worst strategy in the world.
It is.
You're basically turning a trade into a forced marriage.
Yep.
You're tying up your capital in a dead stock out of pure emotional stubbornness.
Yep.
While you could be using that money on a new idea that actually has potential.
Exactly. And worse, it makes you sell your winners way too early.
Oh, yeah.
The stock goes up 20% and that little voice goes, quick, bank it. Don't let it turn into a loser. So you sell and then you watch it go up another 200%. You cut your flowers and water your weeds. It's the complete opposite of what you should be doing.
So let's tie it all together with a final one. The bias that glues all this nonsense together. Anchoring. The reason people are still crying about not selling Bitcoin at 69K.
Spot on. Anchoring is when your brain gets stuck on a completely arbitrary number. Could be the price you bought at or the all-time high. People who bought Bitcoin at 60K are anchored to that price. To them, the real value is up there. So selling at 30K feels like a catastrophic failure, even if the fundamental case is completely changed. They're just anchored to the past.
It's like still thinking a pint should cost £2.50.
Exactly.
Man, the world has moved on. That all-time high from 2 years ago is irrelevant.
Yeah.
It's just a ghost on the chart.
Yeah.
But people let it dictate their entire strategy.
Yeah.
So, when you combine them all, it's a recipe for disaster.
It's the perfect storm. You get overconfident in a bull run. You use confirmation bias to ignore the warning signs. You herd in at the top because of FOMO.
And boom.
Then the market turns. You're anchored to the peak price and refuse to sell. Loss aversion kicks in, so you hold on all the way down, praying for a recovery. Finally, pure panic makes you capitulate and sell at the very bottom, just as the smart money starts buying.
And that right there is the entire market cycle, driven by pure, unfiltered human stupidity.
It is.
It's brutal.
It is. But it's also a massive opportunity, right? If you know this stuff, you can fight it.
That's the whole point. The first step is admitting you have a problem. Know you're susceptible to this.
Right. Know you're susceptible to this.
Write down your trading rules before you enter a trade when you're calm and rational. Have a plan for your entry, your stop loss, and your take profit. That way, when the emotional roller coaster starts, you have a system to fall back on, not just your feelings.
Right.
Be a robot. Don't be a human. Solid advice. Right, that's enough education for one day. My brain hurts. Everyone listening, get in the chat group. The link is down below. Come and have a laugh with us. Tell us about the dumbest trade you ever made because of one of these biases. We've all been there.
Misery loves company. Come share the pain.
Now, here's a question we'd like you to think about. Which of these biases do you see most in the market right now, and how could you position yourself to trade against it? Have a think on that. We'll see you in the chat. Laters.